Ever wondered why a stock keeps falling even when RSI looks high, or why prices rise but RSI refuses to confirm? That's the power of negative divergence. Today, I'll break down how RSI works, what negative divergence means, and how you can turn this knowledge into profitable trading setups. Let's get started. RSI, or Relative Strength Index, is one of the most popular momentum indicators in technical analysis. Developed by J. Wells Wilder, RSI measures the strength and speed of price movements. It's plotted on a scale of 0 to 100. Above 70, overbought zone. Below 30, oversold zone. Around 50, neutral or equilibrium. But here's the catch. Just because RSI is high doesn't mean the stock will fall immediately. That's where divergence gives us the real edge. Negative divergence happens when the price makes a higher high but RSI makes a lower high. This means the stock is rising, but the momentum behind the move is weakening. Think of it like a car going uphill with less and less fuel. It may still move up for a while, but a reversal or at least a pullback is coming soon. There are two main types of negative divergence. Regular negative divergence. Price makes higher highs, RSI makes lower highs. This signals potential trend reversal. Hidden negative divergence. Price makes a lower high, but RSI makes a higher high. This usually signals trend continuation on the downside. So one warns you of reversal, the other confirms continuation. Now let's talk trading strategy. Here's how you can use negative divergence effectively. Step 1. Spot the divergence. Compare price highs with RSI highs. Step 2. Wait for confirmation. Look for bearish candlestick patterns like a shooting star, bearish engulfing, or doji near resistance. Step 3. Entry. Enter short when price closes below a support level or breaks a trend line. Step 4. Stop loss. Place stop loss above the recent swing high. Step 5. Target. Aim for the nearest support or use risk-reward ratio like 1, 2. This way, you're not blindly shorting just because RSI is high, you're waiting for confirmation. Here are a few ways traders use RSI divergence. Swing trading idea. If Nifty forms higher highs but RSI shows lower highs near 18,000, watch for reversal candles and short with target 200-300 points lower. Stock example. Suppose Tesla rises to $300 but RSI fails to cross its previous high near 70. That's your clue to look for a bearish entry with stop loss above $305. Intraday idea. In Bank Nifty, if RSI diverges on the 15-minute chart while price rallies, book your longs early or take aggressive shorts with strict stops. The key is discipline. Divergence is a warning, not a guarantee. Always combine it with price action and volume. Many traders make these mistakes, shorting immediately on divergence without waiting for price confirmation. Ignoring higher timeframe trends, divergence on a 5-minute chart is weak compared to a daily chart. Forgetting risk management. Divergence can persist longer than you expect. So to sum it up, RSI helps you measure momentum, and negative divergence gives you early warning signs of weakness. Combine it with candlestick patterns and support resistance, and you've got a powerful trading setup. If you found this helpful, hit the like button, subscribe for more trading strategies, and drop a comment. Have you ever traded using RSI divergence?